Hey guys, Kylie here and welcome to the channel. So after years of anticipation and rejection, the first of the US Bitcoin ETFs have finally listed on Wall Street. And not only did their listings cause a lot of excitement, after the first two listed in late October, the price of Bitcoin would rally to a new record high. But just a few minutes later, that price would be sent spiraling. The price of Bitcoin on October 27 had dropped by thousands of dollars, from a high of $66,000 to as low as $58,000 in just days. And analysts think the price volatility has been spurred on because of the hype around these new ETFs. But is there more to the story? And could we see these digital asset ETFs distorting the market or resulting in a risky bubble? Well, if you're worried about it, you share those same fears with the US Securities Exchange Commission, the regulator, as well as other analysts, which I'll get to soon. So in this video, I'm going to be looking at what kind of impact these ETFs might have on the price of cryptocurrencies and whether there might be risks if you invest in the space. And to find answers, I reached out to a number of analysts and academics, and it was surprisingly hard to get a straight answer or any response at all. The problem is that it's still such a new area, and a lot of experts in the space have skin in the game, so it's not easy to get a view that is totally unbiased. But I gave it my best, and here's what I found. While the ProShares Bitcoin Strategy ETF might be the first Bitcoin fund to get approved for listing in the United States, it's not actually the first to apply. First application for a US Bitcoin ETF was filed in 2013 by these guys, the Facebook Winklevoss twins that you probably remember from the social network. And numerous other applications have been submitted and rejected by the SEC since then. The difference between most of these failed applications and the newly listed ETFs is how they get exposure to Bitcoin. So for years, fund managers have been trying to launch physical Bitcoin ETFs in the US, where if you buy units in the ETF, physical Bitcoin would actually be bought and sold. But the ProShares and Valkyrie Bitcoin ETFs trade Bitcoin futures contracts, so no physical Bitcoin at this stage is being traded. And arguably, trading Bitcoin futures has a less desirable outcome to buying physical Bitcoin thanks to what's called a contango event. For example, Horizon's front-month rolling futures Bitcoin index has returned 530% in 2 years, while Bitcoin itself returned 660% over the same period. That's a serious lag. So why has the SEC refused to allow physical Bitcoin ETFs? The cryptocurrency space remains largely unregulated. That's kind of the point. But the SEC is wary about giving the green light to an asset whose price is influenced by the activities on an unregulated exchange. They believe this would leave prices open to manipulation, which could become dire for mum and dad investors that now have the easy option of putting their money into these crypto ETFs. This is a real concern. Exchange-traded funds or index funds are hugely popular with retail investors and often used as a way to store and grow retirement funds. The idea is that they're safer because they simply track or mimic a broader market, often a diversified portfolio of stocks. And they're cheaper because no one is actively hunting for new stock opportunities. They're passive, not active. But they've grown so popular in the last decade that index funds now hold up to 30% of US equities and over 11 trillion of investor capital, up from 2 trillion just 10 years ago. And these funds have a real impact on the prices and futures prices of the assets they're holding. And the outcome might not always be predictable. For example, in April 2020, oil price futures fell below zero for the first time in history, and some believe that ETFs had a key role to play in this. At the start of 2020, oil prices had been falling thanks to COVID-19 lockdowns and an oil price war that we soon forgot about. And investors saw it as an opportunity to buy the dip. So this saw billions of dollars pour into oil ETFs. This, under normal circumstances, would help to increase the price of underlying assets. But in this case, it actually contributed to keeping prices lower, even into negative territory. While oil traders were trying to offload contracts to avoid taking physical delivery and so paying for skyrocketing storage costs, oil ETFs were being forced to continue to buy up futures contracts. According to researchers from the Bank of International Settlements, this in turn increased storage costs, which led to continued falling prices. Long story short, exchange-traded funds and index funds aren't as passive as many might think. And in fact, some argue that with so much control of the market, they could eventually become dangerous vehicles, leading to financial market distortions. So it leads the question, what impact will these Bitcoin ETFs have on the market? It's worth noting here that a lot of these futures ETFs are actively managed, which means that aside from the fees being higher, they have the option of totally changing their strategy and adding other assets into the mix. So it's not exactly easy to analyze what impact these could have on the market in the long term. Physical ETFs, it's easier. I asked the founder of Monochrome Asset Management, Jeff Yu, what impacts he has observed. And full disclosure, Monochrome operates a Bitcoin fund and is planning to launch a physical Bitcoin ETF in Australia. So with a physical Bitcoin ETF, Jeff says that in a bull market, it has the potential to soak up supply and drive asset prices higher. And then the reverse is also true in a bear cycle. It has the potential of contributing more sell pressure onto the global Bitcoin market. On the other hand, prices driven from an increase in futures trading would have more of a what he calls sentiment-driven effect, which is kind of what we saw recently after the two futures ETFs listed. What we have witnessed is that futures-based ETFs have more of a sentiment-driven effect, as whilst they do not hold the physical asset, they indicate to the market that regulators have warmed to Bitcoin and see it as an investable asset. The market then takes this as tacit approval, which then sees more inflows into spot markets and driving the prices higher. Yu also points out that Bitcoin has a global secondary market that trades 24/7 with no real closing. Hence, you could expect slightly different price discovery behaviors than traditional equities. And price discovery is what has regulators concerned, and why countries like the US and Australia have been so hesitant about allowing physical Bitcoin ETFs. Price discovery is all about what is influencing prices most. And there is a fear by regulators that if one or a few Bitcoin ETFs become very popular, they could become the dominant driver of Bitcoin prices, above even the regulated futures exchanges like CME. And it's here that some analysts fear we could see ETFs inspire a Bitcoin bubble. If enough funds pour into physical Bitcoin ETFs, that would drive up prices across the market, and you'd have a perpetuating cycle where Bitcoin prices would go up simply because more funds are going into these ETFs. In fact, Australian fund manager Roger Montgomery has argued to avoid ETFs as he says they're distorting prices by unnaturally propping up underperforming companies and even assets. But Bitwise Asset Management, a US cryptocurrency index and fund provider, has strongly rejected that idea. In a couple of white papers released earlier in 2021, Bitwise argued that the regulated CME futures market is the dominant source of price discovery, and no ETF will change that. To back that theory, they looked at previous overseas listings of cryptocurrency ETFs such as Canada's Purpose Bitcoin ETF BTCC. They concluded the data shows, at least in an anecdotal fashion, that even substantial inflows into newly launched ETPs have not correlated with changes in the price of Bitcoin in a statistically significant fashion. And their CIO Matt Hogan even took to Twitter to share their findings in a thread that was shared on other media outlets. The idea is that if CME is proven to be the dominant force in price discovery, it would give the SEC and other regulators more reason to approve physical and other Bitcoin ETFs, because it's regulated. But not everyone agrees with that view. In another report conducted by researchers at the University of Sussex in 2020, they argued that CME far from dominates price discovery, attributing this instead to activity on unregulated exchanges like Huobi, BitMEX, and OKX. They concluded the CME futures have a very minor effect on price discovery, even less than the spot exchanges Bitfinex, Bitstamp, and Coinbase. Our findings highlight the persistent problems stemming from inconsistent regulation in Bitcoin, spot, and derivatives markets, including insufficient price stability and lack of resistance to manipulative trading. And that takes me to the next point. Cryptocurrencies have become hugely popular as an asset class and are undoubtedly here to stay in some form. But the problem we now face is a lack of consistent regulation that has left authorities uncertain of the path forward and confusing the view of whether something like a Bitcoin ETF is a reasonably safe vehicle for investors or unpredictable and easily manipulated. And it kind of is unpredictable because unlike assets such as gold or cash currencies, there is no agreed upon rule book from authorities yet around the world. The same year that China banned Bitcoin, El Salvador made it the country's legal tender. The exciting part of this is that we're at a crossroads, and what happens over the next few months in the ETF space could have a massive impact on how cryptocurrencies are adopted and even regulated in the future. And the good news is, where there is volatility and uncertainty, there are also big opportunities, if you're willing and able to take on that risk. As for the feared bubble, well, there's a very real possibility we're in one, but like Roger says, bubbles come and go. Like the stock market, there will be many bubbles that inflate and explode along the way. If you like this video, don't forget to hit the like and subscribe button. If you think there's more that I should be digging into in this area, please let me know in the comments below. That's it from me, bye.